It's set to be a packed week for the week beginning September 14, with a string of inflation reports set for release from both sides of the Atlantic, and the market braces itself for a potential liftoff from the Federal Reserve when it meets on Thursday. Now on Sunday, we'll get the latest data out of the world's second largest nation, with Chinese retail sales and industrial production. Now, China's economy has been on a roller coaster ride for the past few months, and the central bank is also under mounting pressure to ease policy.
Well, I think if you look at the most recent PMI numbers, it does show that we're seeing a certain amount of contraction within the economy. Add to that the trade surplus, which was a record high at the last juncture, with a fall in exports and in imports too. So definitely a weakening economy there, but industrial production, owing to the base effect, could actually rise a little bit better than this last time round when we see the numbers at the weekend. Equally so, retail sales expected to grow about 10.6% year on year. I think at the moment we are going to be looking for pockets of weakness in China, but it must be borne in mind that yes, it is weakening, but still, even at 6.5% growth, it is still a lot better than most of the Western economies.
Sterling will be closely watched Tuesday, as UK inflation data is scheduled for release at 9:30 in the morning. That's alongside the producer price index and the retail price index. It's then a US data focused afternoon, with US retail sales being the main highlight, with a drop in August sales expected by the market. That's following a solid rebound in July.
Well, what was interesting at the last Bank of England, we saw no rate rise or anything really there, no difference in the voting structure, but we did see a bit of a rally in the pound on Thursday, which was owing to a slight amount of hawkishness, but also calming in relation to what's happening in China. Now, inflation is obviously a big bugbear of the Bank of England, and while it surprisingly rose in July, we are expecting to remain pretty much in around 0.1% year on year, RPI somewhere in around 1% for the third consecutive month. So none of this would put us in a very good position to expect any rate hike. And with regards to the oil prices continuing to drop and look ever so slightly weaker than even in July, then we could more than likely maybe expect to see weaker than expected, perhaps even more contracted towards the end of the year. US retail sales is going to be a very interesting one to watch. Now, certainly what's been interesting for that is that it has been weaker than what was expected very recently, and given the pullbacks in some of the other parts of the economy, including on manufacturing and industrial production there, the consumer is going to have to try and make up the effect there. So I think some of the lower gas and oil prices should make an impact on consumer pockets. So we're forecasting around 0.1% month-on-month increase in retail sales there. Nothing too stellar, but enough to keep the markets on the front foot.
Another sterling-focused morning for Wednesday, with the release of UK employment data. Now, last month, jobs growth in the UK stalled for the second month running. Not long after, EU final inflation for August will be released, followed later in the day by the US inflation figures.
Well, I'm not so certain that, given that there's 2 mandates for the Bank of England, that the employment number is going to make much of a difference. In the forward guidance before from Mark Carney, he did seem to put a lot of focus on employment numbers and, of course, wage growth as well. Now, it is expected the unemployment rate to actually creep back up to 5.6%, and pretty much stay around where it has been. No major differences there, but what will be of concern, I think, over the coming months is perhaps the fact that the oil and gas sector will have lost a fair few jobs, so we could very well see an increase in claimant counts. My baseline on the pound, certainly against the US dollar, is that if we get a rise through the 155.70 level, that's a weekly pivotal point, and it has been a major resistance level over the last number of weeks. If we drive through that, it won't necessarily be on the back of sterling strength, more than likely on the back of dollar weakness, but it would put us on a course heading up towards a key Fibonacci level of around the 157.10.
UK retail sales will be one to watch at Thursday morning, but the attention will soon shift to the US, as all eyes will be firmly placed on the Fed. Brenda discusses the current probability of a move next week and where the markets can go.
Well, I think even in the run-up to the Fed meeting, I think it's going to dominate the events of the coming week. And for the most part, a lot of different brokers have rolled back on what they thought was going to be a shoe-in for a September rate hike. And this comes down to the weakness we're seeing out of China and, of course, the lack of inflation and some poor negative data coming out of the US. But it's 28% probability at the moment, judging by the sovereign debt markets, that it might happen. The US dollar over the last week has pared back some of its gains, which would imply that the markets are starting to reposition themselves for a later date. Now, there's nothing to say that Janet Yellen won't surprise the markets, but what we have at the moment, certainly in the major equity indices, is a consolidation pattern. We've got the FTSE, you've got the S&P 500, and you've got the Dow Jones, all trading in triangular narrowing ranges, where you'd need to see a break of either a sloping downtrend or the sloping uptrend to give you the key direction from where we go from here.
Looking at how next week is shaping up, Brenda shares her view on the most interesting FX pair of the week.
Well, I do obviously like cable. I do feel that at the moment it and the euro dollar are pushing that bit higher, but again that is down to repositioning of some of the dollar trades. My big trade actually at the moment, if I'm really watching it and if it's anything to indicate where the Fed will go from here and what we can expect from inflation, is the gold price. I have looked at this in the past, and it's the 1089 level that we managed to close above that in July. We managed to close above that in August. It's a key Fibonacci level from the highs to the lows that we saw back at the early part of the 2000s. And if we stay above that, there is a narrowing range taking place at the moment that would imply that we could head back up to the highs that we saw last month, around the $1,160–$1,170 per ounce mark. And if those break, then we will ultimately be on a target towards 1200 on the downside. If 1089 breaks, then we are going to languish towards those lows and more than likely break the 1000 marker.
And that wraps up the week ahead. Enjoy your weekend. Goodbye for now.